there, hope you're doing great today. In today's quick video, we'll discuss the 3 most common fears and concerns of passive investors based on a number of conversations I've had with current and prospective passive investing partners. But before we begin, just a quick reminder that our videos are for educational and entertainment purposes only and do not constitute tax, legal, or investment advice. So let's begin. Number 1 is communication. Frequent, transparent communication, open communication. After all, if you think about it, many passive investors are investing a substantial amount of money. The minimum for many deals starts at 50 to 100,000, so that's not a small sum. So it's important for many of them, and I'm a passive investor as well, so I speak for myself. It's important that we have that connection, open, ongoing dialogue with the sponsor. Not all investments go perfectly as planned, and sometimes obstacles do arise. Actually, more often than not, they do arise. But as a passive investing partner, I prefer that such bad news or challenging news is shared early in advance, along with suggested action plan by the sponsor. So if everything is going well, that's fine, but if things are not going well, LPs prefer that such news is delivered early in advance and do not come as a shock or surprise. Number 2 is diversification. I speak with many passive investors who, after many years investing in the stock market, are simply tired of riding the roller coaster ride given the volatility of the stock market. Of course, investing in stocks has its benefits, including more immediate liquidity, unlike, for example, real estate that is illiquid. But at the end of the day, it's an equity play, whereas with real estate, a lot of what passive investors are looking for, myself included, is that ongoing cash flow, so not solely relying on the exit for that equity yield, but ongoing cash flow as well as tax benefits. And number 3 is loss of principal, and that is real. Just like any investment, real estate carries risks as well. So it is important to understand what that downside is, what the risks are, and how they can be mitigated or mitigated at all before jumping into an investment opportunity. So our firm takes a lot of time up front to do diligence on the sponsor, on the market, on the deal, and the documents, all of these 4 key areas before we invest and present that opportunity to others who want to join us in on that. So taking the time to do the vetting, measure twice, cut once type of process certainly helps mitigate, not eliminate, such risks. So communication, diversification, loss of principal tend to be the 3 most common fears or concerns brought up by passive investors I speak with daily, and I can certainly relate because I'm a passive investor myself. And I hope you found today's video helpful, and if you did, please like, share, and subscribe, and we'll see you at the next one.